I'm Nicole Bullock from the FT Markets team. Apple, the most valuable company in the world by market cap, has sold $12 billion of bonds in a very choppy market. Eric Platt, also of the Markets team, is covering the story. Eric, what should we make of this?
Great, Nicole. So it's been a really choppy market in the debt world over the past few weeks. Though we saw anheuser-busch come with a mega deal earlier this year, Apple's $12 billion deal is following on its heels as the second largest. And that's kind of a testament of there's just been a lack of deals so far. Investors have been nervous about investing in choppy markets, especially if they're going to buy something at 100 cents on the dollar and see it drop to 96 cents on the dollar the next day.
So how did the deal go? What can we say about investor demand for going forward?
So Apple had to pay up for this deal. Talking to investors, they said they had to pay an extra 25 to 30 basis points compared to where their previous bonds that they had sold had priced. But that said, there was pretty strong demand, about $28 billion in orders for the $12 billion sale, which bankers were pleased with. But when you compare that to Anheuser-Busch, which topped up $110 billion in orders, investors said, well, that was kind of a marquee offering. Apple's been doing this quite a bit over the past few years, so investors already have a lot of Apple bonds on their portfolios, and so adding any more is quite a stretch.
And can you tell us a little bit about why Apple is doing this? Don't they have tons of cash?
They do, but the issue is they have tons of cash overseas, and if they were to bring it back, they would get hit with quite a hefty tax, although I shouldn't be the one to judge. And so what they're doing instead is raising cash here by selling bonds and then using it to buy back stock or issue dividends. So it's more tax effective, benefits shareholders like Carl Icahn.
Okay, and it's been pretty brutal in the equity market for tech of late. Is that the same thing that's happening in the bond market, or are we seeing a bit of a dichotomy?
It is. You've seen a lot of the lower rated companies sell off quite a bit with the equities. Even though they're higher in the capital structure and have more protection, there's a lot of nerves have frayed that maybe all the expectations we had earlier this year or last year of how much growth they had isn't really in store. So there has been a repricing, but companies like Apple still enjoy pretty favorable terms when coming to market.
So is this, can this be seen as a sign of what's to come? Is Apple reopening the market for more deal flow as February progresses?
I think they are, and investors are really watching this as a barometer. You also saw Comcast and IBM come with bonds today. And so what people want to see is how do they trade in the coming 3 days? We saw bonds issued early this year really sell off, which left investors who bought in kind of unhappy. So if these bonds do trade up and equity markets stabilize a bit, we could see the spigot open and kind of all companies that have been waiting for earnings season to get done come to market.
Okay, great. Thanks, Eric.
Thanks, Nicole.